There's the stocks today. It does take us to our talk of the tape. Where exactly is this economy and stock market going? Let's welcome our panel. Steve Liesman, CNBC senior economics correspondent. Stephanie Link with Hightower and a CNBC contributor. Dan Greenhaus of Solus Alternative Asset Management. It's good to have everybody with us. Steph, you looked into the data today and didn't come out as gloomy as some others.
No, the headline number was disappointing, negative 0.3. But if you do look underneath the surface, business equipment investment rose 22%. Consumption rose 1.8%. And yes, it's down from 4% last quarter. I get it. However, it is actually better than what people were thinking, like 1.2%. And then, of course, you look at final sales to private domestic purchases. That was up 3%. That strips away a lot of the noise, trade and inventory and government spending. So you get true demand. And that demand was 3%. So it is a better than expected number. And that's why we actually rallied from the lows, not out of the woods. I understand GDP is actually backward looking. But the other data points today that I was excited about, personal income and personal spending. We get the soft data all the time on confidence and sentiment, and it's been awful. But we got the best spending number since January of 2023 this past month, in the month of March. So I'm encouraged about that. That is something. And then also pending home sales. I mean, that's a leading indicator, and maybe it has to do with rates coming down and seasonally, but up 6.1% month over month. That's encouraging. Not all is perfect, Scott, but I'm trying to look at some of the bright spots in terms of where we're at.
So is this gentleman sitting next to you who calls today's GDP print a fake out. Why so? You agree with everything Stephanie said?
Yeah, because she's right. The headline number is completely irrelevant. We knew coming into March that the numbers in the trade numbers in January and February were screwed up by some gold arbitrage that was going on between the U.S. and the rest of the country. And then March saw a big pull forward in front of tariffs. So you have to look at this number X trade, because trade was the biggest drag on GDP that we've seen in decades and decades and decades. Go to my Twitter. There's a chart there. So when you look at it X that stuff, what we call real final sales to domestic purchasers, which is an alternative way of looking at GDP, was plus 3%.
No, but X trade is like saying X the elephant in the room.
Yes, except that, but listen, I get the elephant in the room in March, but January and February, the trade data was skewed by particularly gold inflows. I get it. I don't mean to sit here and say, well, X all the alcohol I consume, my diet is phenomenal. I understand you can't exactly do that, but it is fair at least to look at it that way. I'm not saying GDP was amazing otherwise, but it wasn't negative.
All right. So, Steve Liesman, you've heard these takes, and there have been many negative takes today as well. Square both.
I don't know why those guys leave it to me to be the guy that's the party pooper here, but I'll tell you this. I've come to the conclusion that if I'm looking at a piece of data and I don't understand how it's been affected by the tariffs, I need to look harder. And that is true of many of the positive things that Steph talked about, unfortunately, I think, which is that you had a whole bunch of consumption that was driven by people front-running autos and front-running tariffs on autos and buying cars ahead of time. I believe that flattered the first quarter numbers. I think she's right, though, to look positively at the income and spending numbers. It's what tells me, Scott, that we could yet escape a recession here if policy is, let's put it this way, put on a more rational plane and clarified in a way that allows businesses to invest and not be frozen by the uncertainty. And I'll show you a chart that is why I think this quarter's number was lousy on the headline, but fine underneath. And I'll explain why I think it's going to look fine next quarter or this quarter, but lousy underneath. And you can see here, if you look at the contributions to growth, thank you guys in the back. You didn't even know where I was going and you went there. There's inventories helping out the GDP number. This is how we got to minus 0.3, okay? You can see fixed investment. As Steph said, that was good. Spending, I think that was as the contribution, flattered, I think, by autos. And there's that big net export number. Next quarter, that net export number reverses. The inventory number goes the other way. And it's spending that I'm worried about, that all of the sentiment, the lousy sentiment, some of the worst sentiment numbers we've seen in a 3-month period, and never outside of a recession have we seen a sentiment decline like this when it comes to expectations. That's what I'm worried about, is that you don't get the spending because you had all that pull forward on the auto and some other side, Scott.
The point being, it's simply too soon
Yeah.
to look at the real data and think that the trade war and these, historically high tariffs have played much of an impact yet. Liesman's point is, too, in terms of demand, it's not necessarily, quote unquote, real. It's not fake, but it's exaggerated by the pull forward aspect.
Well, so I think that's why jobs in the labor market is so important, because if that starts to turn, then the consumer then starts to really turn. Right now, we are getting pretty okay data. ADP was not great today, but I think weekly jobless claims are something that I pay much more attention to. I know Dan does too.
Because you think it's more in the moment.
Yeah. It's coincident to leading indicating data points versus non-farm payrolls is backward looking, right? So is ADP to some degree. So I'm just looking at jobs. I'm looking at a first quarter ECI, employment cost index, at 4.6%. That means that people are getting paid 4.6% on average, some more, some less. But the point being is, if you have jobs and you have wages, and oh, by the way, inflation is sort of tame. It's not accelerating, and gasoline prices are down. And we got a couple of data points today on inflation that it's not, again, not accelerating. So if you have all these things and you add it all up, you actually have a 4% savings rate, too. I think if we do see a slowdown, the consumer is in a better place to handle the slowdown.